see it? Excellent presentation. Well, hello everyone. Nice to formally meet you. My name is Nick Garcia and I'm the CEO of Fortunafi. So our vision is to bring institutional yield products to DeFi by rebuilding the securitization stack from the ground up. I'm the CEO and my co-founder is Jason Smith. We are also general partners at a crypto fund called Space Whale Capital. It's a proprietary investment vehicle that manages a discretionary liquid trading strategy and actively participates and invests in DeFi. We started investing in the space in 2016 and have been very active in the DeFi space across all these names on the screen here. Early investors, part of the community, pretty involved. And so we've been really thinking of unique ways to capitalize and create yield opportunities for people as fund managers. We've been looking to allocate a portion of our capital to a low risk, consistent yield return. We've invested across the DeFi stack, and there are really a lot of really interesting investment opportunities, but there are still a lot of incredible opportunities to create. And so we've come up with Fortunafi to try to tackle that. I'm sure a lot of you have seen this chart in the past of the negative yielding debt across the world, but for those that you haven't, there's over $17 trillion in negative yielding debt globally, which is a massive number. This is investment grade debt globally. It hit that number in the end of 2019 and it's right back there. And with yields staying the way they are for the next few years, I would expect that this is going to continue to go up. Just to put this in comparison across other large asset classes, the US mortgage-backed security market is 14 trillion. So it's bigger than the entire US mortgage-backed security market. It's bigger than the $12 trillion US Treasury market, all the way down to the DeFi market, which is 12 billion. I think it's actually 13 billion roughly now, which is just a speck compared to this. I also expect that this DeFi market will substantially grow over the next decade. So our solution is to create institutional yield for everyone. We're looking to get higher yield from real world assets, bring in institutional risk management, and offer an uncorrelated investment. We are acquiring real world assets through partnerships with asset originators. Our first asset originator is actually going to do a demo here on our call after I finish the presentation. Coral, very interesting technology that they've built, so I'm excited for you guys to see it. So we've partnered with them for the first pool to originate our assets. And we're bringing in our own capital from our fund, and we're bringing in additional capital through private investors and other funds as well in the space. We're creating two investment products. The first, what many of you know as Drop, we're calling it a treasury token. This is our low risk, lower yield, still very attractive yield at 10% for this first pool. And next year, we're going to be releasing a new product called the Yield Dollar, which is going to be a type of synthetic on the tin side, but more of that to come later. Just to give you guys an overview of our strategy. So we seek to provide liquidity, partner with originators, and scale operations of the pools. So in a traditional asset securitization stack, I'm sure some of you are familiar, but for those of you that are not, there are many different participants involved, starting with the borrower that's creating the asset or the company. You have an asset originator, somebody that's originating this thing. You have somebody that's putting a warehouse capital facility in place so that the asset originator can purchase the capital, purchase the asset. You have a takeout partner. These are usually banks or private equity firms that are pooling a number of these assets together to create a securitization. All of these different steps, there are middlemen involved, there are high costs involved. It's a complicated process. It's reserved for institutions. It's highly complicated with a lot of intermediaries involved. And then you finally end up with this bond that traditionally sovereign wealth funds and other institutions can acquire. We believe we've redone this entire stack. So to acquire the assets, we're partnering with asset originators. We're providing both the warehouse capital and the takeout. We're actually purchasing these assets through our on-chain credit fund, which we're calling Fortunafi Asset Management. And then we're creating the investment product through smart contracts, through partnerships with Centrifuge, and then some additional code that we're building as well. So for our first pool, the Drop APY, which again, we're calling the treasury token, is 10% per year. We're starting the pool next week on Thursday. The starting pool size is $1 million. We're going to scale that to $10 million over the next 6 months, 6 to 12 months roughly, with our partner Coral, whom again is going to be on pretty soon. The average asset size is about 150 as we scale the pool up, that average asset size will increase as well. These are revenue-based financing assets, which I'll go into a little bit for those of you that are not familiar. These are US-based assets with a 24-month duration, but you will get paid out through the pool distributions, your 10% per year. But these assets have a duration of 24 months. These are theoretically evergreen assets. So in future pools, we could decide to remove this expiration and let there be continued cash flow until the company decides to purchase these assets back. But for this first initial pool, we've decided to cap it at 24 months so that our first set of investors have a sense of finality and can build trust as we scale these pools. This is a 506C offering under Reg D. Investors are going to get a 1099. And this is available to both US and non-US investors. So a little bit of information on revenue-based financing assets. I believe this to be like one of the most interesting asset classes that are scaling. There's a lot of interesting companies in this space. We love what the guys at Coral are doing, which is why we've decided to partner with them. But revenue-based assets, these are really assets that companies need to raise capital rather than raise equity and dilute themselves or raise a big debt round. They can choose to sell a portion of their cash flows. Sometimes this is in the form of a royalty on revenue. Sometimes this is a form of basically cash advance against a SaaS contract. But in our case, this is really a percentage of revenue that we're acquiring from these companies. And as you can see, revenue fluctuates month over month, and so will the cash flows. But the calculations and the deal that we put together with these clients come out to the target return that we're targeting. So why revenue-based financing assets? It has a very interesting risk and reward appetite. So when you look across the asset stack, you really have government debt being the lowest of the low risk. And then you have crypto being potentially the highest of the risk, the most volatile, right? We believe revenue-based assets to be somewhere in the area of senior debt. They are the senior most debt. They have senior most lien on these companies, except the return profile is more like equity/venture style returns. So we find this very interesting for yielding assets. A little bit of information on Coral here. They were founded in 2016. They've got a phenomenal technology stack, which I'm excited to show you guys. And they've been partnering with the Canadian government and directly originating themselves. They aggregate a number of information to do automated underwriting on. And then they create a proprietary credit score on all of these assets. And then they have an incredible dashboard to view all the metrics and analysis. I will turn it over to Derek, who's the CEO of Coral now. He can walk you through his process and the application flow and the analysis and the underwriting. And then we'll be happy to answer any questions at the end. Thank you.
Thanks, Nick. I'll just go ahead and share my screen whenever you pass back access here.
There you go.
I cannot share a screen while other participant is still sharing. There we go. Thank you. As Nick mentioned, I'm Derek, the CEO at Coral. We have been around since 2016, largely focused on capital as a service. Over the last 4 years, we've built up a software stack and a series of models that allow us to offer fast, fair, and flexible financing to small businesses and startups, predominantly in the United States, using revenue-based financing, or what we like to call revenue sharing. Nick did a great job at explaining what the instrument itself is. I'm going to provide you today with a little bit more context around how we actually originate these assets. And share the data that we're collecting on these businesses. So to kick that off, as a business, the experience is actually quite straightforward. You would essentially click on Apply Now and go through an application process that takes under 5 minutes to complete. For the sake of time, I will just walk you through some of the screenshots here and give you an overview of the data that we're collecting. So this first page really is more about collecting the account level information that we can capture then for ongoing follow-up. The company page here is where we get more of an information around the company structure, number of employees, business category. The types of businesses that we specifically target are what we call digital economy companies. So these are largely businesses that make the majority of their revenue online. And this typical profile may be an e-commerce startup or a technology SaaS company. So we get a large number of businesses that, from a venture perspective, would fall into seed or Series A, but almost entirely post-revenue companies, because that's the focus and the nature of revenue-based financing. On the financial page here, we collect just a high-level snapshot of the business's financial position. This allows us to determine whether we move forward through the application process with the business. And if they do have a minimum of at least $50,000 in monthly revenue, we proceed to the review page. Now, what you'll notice here is that we have a number of different widgets, or the ability effectively to connect to banking accounts, accounting software systems, and payment processor data directly on this business. We've designed our application process to be the most comprehensive out of any other revenue-based financer that we're aware of in the world. And to that effect, we've actually white labeled our software to a number of clients, including the Canadian government, that's currently using our software to evaluate women-led and minority-led businesses in Canada as part of a COVID-19 relief program. So the idea behind this main page is to collect as much data on a business as possible for the purpose of providing capital as a service to them. The final page here in the process is really just KYC. Anyone that owns more than 25% of the business, we're collecting information on. And this feeds into our qualitative and legal due diligence later on. And that's pretty much it for the business. So it's quite simple. You put in your user credentials, we get access to all that data. They get redirected to their business portal here, which they can then essentially use to understand where they are in the flow of the application process. And then once we've collected all that data, the fun starts for us. And so what we've actually built out is a onboarding or dashboard process here, where we can log into our backend systems and monitor all of the applications that have come through our system. And so what you'll notice here on this portfolio search tab is essentially the list of all the different types of companies that have come through our application process. And I'm showing you some fake data here today, but the first thing we do is we calculate an investment score. So using all the data, which on average is more than 10,000 data points on a business, we're able to come up with an investment score between 0 and 1,000 that represents an indication of what the risk and return profile of that asset or business is. And so in this case, for those that are familiar with credit, we consider anything that's greater than a 790 score as BBB+, and we don't consider anything lower grade than that. For the purposes of actually going in and understanding the business at a deeper level, we actually generate automated due diligence reports or investment reports. And this is a snapshot at any point in time on a business that gives a complete picture of the company, the team, the marketing position, banking, financials, risk metrics, valuation figures, investment terms. So we actually automate the investment terms for each of the contracts. And then of course, benchmark analysis, so that we can actually find comparisons between other companies that have applied for financing with us. So I'm gonna briefly kind of go through the investment report here on a demo business. I'll start with essentially the marketing here. And just to give you a scope of all the information that we're collecting on the business. So if a business connects to us, let's say through Google Analytics, then we're going to be able to grab all that data in. We're going to understand the traffic that they get on their web applications, the customer engagement. We're doing forecasts as well. We can get geographic distributions of where their customers are coming from, what search statistics provide organic or paid volume to their businesses, and the keywords associated with that. In certain cases, we actually come up with product trends. You know, certain product trends are hotter than others. For example, everyone's cooped up, working from home. So, you know, health-related activities, office supplies for the home. These are emerging trends today. On the banking side, we're collecting all of the transactions among their deposit accounts, going back in time for at least 60 days, at least 90 days. And we're able to take all the transaction level information in and do analysis on that. So we have transaction summaries on debits and credits, volume of balances in different accounts, categorizing all of the transactions in and out of the business, so we can get a complete picture of how the money that we give them will be spent. In addition to that, and largely where most of the data is that we gather, is from accounting software systems. And so in the financial section here, we actually have all of the major financial reports, both at high-level summary levels, for example, like income statement positions, but then also deep dive down at the account level. So we know exactly what the income, cost of goods sold, expenses, and other income and expenses are on this business over time. We do the same for the balance sheet, so we can get a really good understanding of the capital stack of the business, which is unique for revenue-based financing because, as Nick mentioned, this is really a hybrid instrument. It's mezzanine-like debt risk with equity-like returns. And so we need to get a good understanding of not only the revenue position of the company, but then also the debt stack beneath them. And for most of the businesses, in fact, all the businesses that will be originating as part of the pool, they will be senior secured. We will be filing UCCs in the appropriate state so that we have a claim over all of the intangible and tangible assets of the business. And of course, finally, there's cash flow statements, financial ratios, revenue per customer and employee, financial projections. There's a host of detailed information here that our analysts can go through in order to help determine whether the company gets financing. And it all starts really with that investment score that I mentioned before. Everything that you see in this report here gets aggregated up and fed through a series of our models in order to come up with essentially a go or no go decision on the business. And we can flip that around within 24 hours after a business has applied. But everything you're seeing here, all the detailed probability of default, the real-time liquidation values on the company, the exposure at default on our royalty investment, expected losses and returns, all of this detail is available within 10 minutes from the point in time in which a company applies for financing with us. The last thing I really want to drive home here is on the investment section of the report. So if it wasn't already obvious from before, we really tried to automate as much as possible around the analysis and the investment process. And we've done so the same way regarding the terms that we use to price the revenue-based financing assets. So as Nick mentioned, there's effectively two parameters that are core to this type of instrument. One is the buyout rate. So the business has the option to buy out our investment at any point in time at a multiple. And of course, the repayment rate or royalty rate. And that determines essentially what percentage of revenue we collect on a monthly basis. And that will drive the yields of the pool. And so our risk-based pricing engine actually comes up with the optimal terms in order for us to achieve our target IRR. And of course, this report gets updated monthly. It's not just a single snapshot. It allows us to actively monitor all of our investments and our portfolio over time so that we can identify early warning trends, high-flying businesses to determine where we should be allocating capital in the future. And it really helps drive home the returns that we see in our portfolio today and the pool that will be going live next week.
Awesome. That was fantastic, Derek. Thank you.
Great.
I guess if anyone has any questions, happy to take questions.
Also, if you're a bit shy, feel free to just drop the questions in the chat. In the meantime, maybe Nick, you can tell us a little bit about the launch plan. Oh yeah.
Could I ask a question, Leah?
Sure. Go ahead.
Derek, I had sent you, this is Jason. I had sent you some messages, and sure we'll talk on the side, but I'm curious here for everybody. How long have you been building this model to determine that score? How has it evolved over time? And how accurate, is there any way to test its accuracy?
Yeah, so we've been working on the model for over 3 years. It's been calibrated on a large set of North American businesses. We've actually pulled in a number of alternative data sources as well, covering business, like well over 200,000 businesses in North America. We have well over 1,000 businesses now that have well over 10,000 data points that we've actually used as part of the modeling exercise. The best way to think about the improvements to the model over time is that we've undergone a series of retraining. So every time a new business applies for financing, the model gets retrained. So it's updated in real time. It's a series of risk and return models that we've used to effectively maximize risk-adjusted return on capital. That's our optimization. And then with regards to a lot of the inputs, it's everything you saw in the report. So you can think of tens of thousands of different variables that represent inputs from financial, marketing, operational, banking. Really, it's across the entire dimension stack that we do have on data. In terms of performance, we've backtested the model among an out-of-sample data set going back since June of 2018. So most recent, our backtest was a 2-year period. The returns from our model for any businesses that scored greater than a 790 per our investment score generated a return of 40% annualized on an IRR basis. And in fact, the portfolio that we have that's live today based on the same model is tracking pretty well to that. It's just north of 40% annualized on an IRR basis. Forward testing is obviously important, right? We want to make sure that any new deals that we do feed through the model have a similar profile to what the model was trained upon. And so that's why we're consistently retraining every time new businesses come on the platform.
Cool. If there's no other questions, I'll ask another one. I would love to know, since these are revenue-based loans, there's no end term to the loan. How do you know if a business is performing above or below expectation? And how do you determine when to consider the business in delinquency or in default?
Yeah, so in terms of performance, what we do is we do have revenue projections. So we are able to project on a monthly basis how we believe the business will perform in future periods. And so the way that we measure performance is relative to that benchmark forecast. And so if, for example, a business drops below 30% of what their projected revenue would be, then that runs a red flag for us. We also, on a monthly basis, review all of the business reports to identify any anomalies. So, for example, large transactions, suspicious transactions, breaches of certain financial ratio thresholds. And so all of that goes into our ongoing monitoring. And I would say from the standpoint of the business itself, we can usually get a good indication of how they're performing as a result of ongoing conversations with them. We're not necessarily hands-off, and often the types of businesses that come to us want revenue-based financing in advance of doing a larger fundraise on the equity side in many cases. And so we're often almost like a bridge capital for them, and they're going to be using our capital to hit certain metrics. And when they come to us and say, hey, we want us to hit these metrics, and they do, then we know that they've hit the targets that were set forth for us. But you're right, they are perpetual in nature. That is quite beneficial for us in the sense that we're not only trying to manage the willingness and ability for the company to make repayments, but we're also managing the growth prospects of the business as well as part of our decision-making process. In terms of how we manage delinquencies and defaults, any non-payment within 7 days of month end determines delinquency and in fact default on the business. So we run a really tight ship with that. And we are actively monitoring their accounts because we have direct access to banking and their accounting information. So we in fact know when they're probably about to default on a loan before they or their credit bureau will.
Cool. Looks like there's another question in the chat. What % of leads translate into actual loans? See that?
That's a good question. We are highly selective. So I would say out of the top of the funnel, all the businesses that come through, probably about 40% of them meet our minimum eligibility criteria, our minimum growth rates for the companies, our minimum revenue values. And then on a total aggregate basis, less than 5% would be actually financed. So if we're talking about 1,000 companies, 50 companies would be financed as a result of that. And in fact, for this given pool, we're going to be a little bit more restrictive in the types of assets that we're going after, so they can meet a certain profile that we have to have high yields for the pool.
Okay, cool. Okay, there's one more question, and then we're almost running out of time, but maybe we can take this last one. What are the types of businesses that come in for financing? What kind of annual revenues? Yeah,
so these were what I would call digital businesses. They make more than 90% of their revenue through online sources, e-commerce, software as a service, online services in general. These are companies that are typically at least 50,000 in monthly revenue. That's their minimum. But on average, we see around 150 to 175,000 in monthly revenue. So just around kind of the 1 million mark in annual revenue. And these types of businesses are growing, for example, at least 30% year over year. At minimum, they would have at least 2 years of operating history and at least 6 months of revenue history.
Okay, cool. Then let's maybe wrap up. I said the Blink pool is already live. You can see it on the Tinlake website. Maybe just Nick and Derek, if what's the best way to reach you before, if people have questions before your launch next week? Maybe you can just drop it in here or.
Yeah, absolutely. So on the last slide of the deck, I had an email, but it's pretty simple. It's just nick@fortunafi.com. Derek, you want to go? We'll just post it in the chat.
Yeah, I just posted my email address in the chat for anyone that has questions.
Okay, perfect. Yeah, if there's nothing left or no other questions, then I'd suggest we'll close for today. And feel free to continue a conversation on Discord. Reach out to either Centrifuge team, us, or to the asset originators directly.
Great. Thanks, everyone.
Thanks, guys.
Take care.
Thank you.